the core flexible CPI from the Atlanta Fed is outright deflation right now. Outright deflation. The stuff that is linked to the economic cycle is deflating, and that downward momentum is actually accelerating. So yes, there is deflationary pressures that are intensifying in the economy that clearly aren't fully priced in. We haven't had the storm, but the clouds are rolling in, and frankly, I'm rather concerned.
David Rosenberg returns to the show. He is a founder and president of Rosenberg Research. We'll be talking about his updated macro views and where he believes opportunities lie with investors today. Welcome back to the show, David.
David, thank you for having me on. It's been too long.
Yeah, I
took the words out of your mouth.
You did. Jinx. No, just kidding. We love having you on. Our audience missed you. Let's recap what you told the audience last year. You were calling for a potential recession at some point. You were looking at the indicators. Let's talk about those indicators today. You also said that the Fed, if a recession were to hit, is likely to cut rates by up to 500 basis points because historically, that's what they've done in the past.
In recessions, and again, I put my historian hat on, and maybe you'll say, well, it's different this time. I don't know why it will be. The Fed cuts rates 500 basis points in a recession historically. So maybe all this all along was more about getting more bullets in the chamber to fight the next recession so that they don't have to go to QE again. They'll just end up cutting rates to zero. But I actually think in the next 12 to 18 months, we're going back to the zero bound on the funds rate.
Are you sticking with that view?
Well, the historical facts don't change. So the answer is yes. If we slip into an outright recession, which would be very deflationary, the Fed will probably cut rates back towards the zero bound. I'm not going to say they'll go right down towards zero, but what's more important is that the Fed will cut rates way more than what's priced in to the swaps curve or the bond market. So that view holds. And again, in this business of economics, your assumptions drive your conclusions. So if we get a recession, yes, 500 basis points or something of that order of magnitude over the next 24 months. And even if we get this elongated soft landing and inflation comes down, I think at a minimum, the Fed will take the funds rate down towards its own estimate of neutral or equilibrium, which is 2 5/8. And so, all roads lead to much lower interest rates with or without a recession.
You're talking about lower Fed funds rate or the 10-year?
Well, the thing is that the most important correlation to the 10-year note, there's a bunch of correlations. Fiscal policy has a correlation, wages, inflation, core inflation, the economy. But the most important correlation, 90% correlation, is with the direction of monetary policy. We went into this bear market in Treasuries because of the Fed taking the cost of carry away so aggressively. And of course, in response to everything that was happening in the economy and inflation, but monetary policy bulks very large. So the whole curve will downshift. The biggest declines in rates will be at the front end of the curve, as is usual in an easing cycle, and especially in recessions. But the whole curve will move down. The yield curve will pivot from inversion to positive slope. I guess you could argue that would be good news for the financials. However, the best total return potential is going to be the long end of the yield curve. Even though the yield doesn't go down as much as the front end, you get the price appreciation and the convexity giving you what I think is going to be a double-digit return in bonds over the course, and long-term bonds over the next 12 months.
On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of US companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. Oh, I want to come back to bonds and the other asset classes in just a bit, but just on the Fed. So in a speech on Monday, Olli Rehn, ECB Governing Council member and head of Finland's central bank, said that thanks to this disinflationary process, inflation is converging to our 2% target in a sustained way, and the time is thus ripe in June to ease the monetary policy stance and start cutting rates. So if the ECB starts cutting rates this month, David, is that going to put pressure on the Fed to start cutting soon as well?
No. And the Bank of Canada probably is going to start cutting rates too. And not long after that, we'll see the Bank of England. I think that the Fed is going to drag its heels a while longer. But I think that you've had other central banks already begin this process. The Fed doesn't have to lead it. But in 6 months' time, we will be talking about a global backdrop of lower policy rates. Sometimes the Fed leads, sometimes it lags. This time around, it's going to lag. But it doesn't really have an influence on the ECB one way or the other. They're responding to their domestic considerations. And the Fed's going to do likewise as far as the U.S. backdrop is concerned.
Core inflation still remains strong in the U.S. Do you think there's a particular reason as to why it's still sticky?
Well, really for two reasons. One is the fact that you're seeing, especially this year, when people talk about the bump in inflation, 100% of the deviation in the inflation numbers this year benchmarked against the disinflation trend that we had last year, all of it has come from insurance premiums, principally auto insurance, but also health insurance and tenant insurance. And the biggest one has been auto insurance. Auto insurance costs are up 22% year over year. And that has nothing to do with the economy. It has nothing to do with Fed policy. It has nothing to do with liquidity. It's the insurance companies responding to their horrible claims experience over the course of the past couple of years. And it's very, very idiosyncratic, as it is with those other two aspects, health insurance premiums, which looks to be a seasonal skew, and tenant or homeowner insurance, which seems to be, you could argue, related to what's happening in terms of the climate change and claims associated with hurricanes and tornadoes and floods, so on and so forth. That's not inflation that the Fed can really control. Of course, it would be problematic if it fed into inflation expectations, but I'm looking at the 5-year and 10-year, TIPS break-even levels in the market for real return bonds, and they're basically 2.3%. They haven't budged in really 3 years, despite all the hype over inflation. The longer-term market-based inflation expectations have been broadly stable. On top of that, what makes the U.S. special is the rental components. Europe does not have OER in their data. They don't have owner's equivalent rent. They don't have a question. I mean, the question in the CPI in the United States to the sample of homeowners is, what do you think you can rent your unit out for if you could rent it out? It's a fuzzy number. It's part of the index. It's a 27% chunk. Canada does not have OER. And most of the Canadian inflation measures have already moved to or even below the Bank of Canada's target. And the Eurozone doesn't have owner's equivalent rent. Only the US has this, bizarre and dominant component. And the rental numbers are subsiding, but it's been painfully slow for a variety of reasons. But it's really a rental and insurance premium story. Everything outside of that is pretty dormant. And in fact, if you looked at the US CPI on a harmonized basis in the same way that they do it in Europe, core inflation in the United States on a European basis is running at 1.9%. And that's even lower than it is in the euro area. And the ECB, like you said, is about to cut rates. And the Fed is there telling everybody, well, it might be next year's story, or maybe one cut by the end of the year. So there's other things going on. But I've got to say that the most appropriate thing that Alan Greenspan, ever said was in 1996 at an FOMC meeting when he told Janet Yellen that the CPI is, in quotes, a flawed statistic. And what I found about these previous versions of the Federal Reserve, from Greenspan to Bernanke to Yellen, was they took a very eclectic approach towards inflation, towards supply and demand, towards the overall economic backdrop. And they did base policy based on their forecasts, not on backward-looking indicators. But you see what's happened here is that Jay Powell and his brethren at the Fed have everybody just focused on the CPI and the PC deflator, even though these are lagging indicators. And the CPI in particular, which has been more problematic than the PC deflator, is so dominated by the rental components. But that's what the Fed's looking at. I mean, when you go to the index of lagging indicators from the Conference Board, they have the leading indicators, the coincident indicators. Service sector inflation is in the index of lagging indicators. So we have a central bank, the world's most dominant central bank, is operating policy looking exclusively at coincident or contemporaneous and lagging indicators. And I find that to be a bit of a problem. And that's why I haven't walked away from the recession view, even though technically it hasn't happened yet. But we have a central bank and everybody is on board. Every CPI, we have, I saw Jan Hatzius on CNBC being interviewed, and he's talking about his upcoming forecasts for the inflation data. And Goldman Sachs is now forecasting CPI and PC deflators to the second decimal place, 0.26, 0.32, 0.28. That's because the Fed has everybody on pins and needles over one number, which is CPI and PC deflator, which are lagging indicators. And the market's become so hypersensitive that now you have the bellwether Wall Street economists at these big banks forecasting the numbers for the first time ever, publishing forecasts to the second decimal place. That is how anally retentive we become over these month-to-month price indicators, which are lagging to begin with. It boggles the mind.
I recall the ECB actually raised rates in, I think, 2008, right before Lehman crashed.
Trichet raised rates, not just that.
Yeah.
Not just that, but Bernanke, the Fed, this was back in the June '08 meeting. Think of what happened next to Fannie and Freddie, and then Lehman, AIG, Mother Merrill, where I was working. That was in September. Fannie and Freddie was in July. This is the June meeting in '08. And the Fed switched to a tightening bias. It's hard to believe. And in fact, one of the FOMC voters of the day, Richard Fisher from Dallas, voted for a rate hike. And yet we bow down to the holy grail of what these central bankers say. It's not just the CPI data. You cannot get through a day without 3, 4, or 5 Fed officials going to the podium. It's like there's not a microphone that these people wouldn't want to grab. And it's just sowing more confusion into the marketplace.
I remember why they did that, because
it's caused investors to take their eye off the ball, because we have to focus on what the Fed's focusing on. So instead of focusing on the intermediate to longer term, we become hypersensitive to lagging indicators like the CPI and the PC deflator.
It's because
this is what's really changed in our industry the most.
Yeah, well, I think where I was going with that, they were looking at a lot of things. Oil spiked to nearly $200 in the summer of 2008. They were looking at that and they were worried that would cause inflation. So yeah, you're right. So perhaps they should start looking at other
Well,
things.
inflation, well, WTI got up close to 150. Uh, and inflation got almost to 6%. That was the summer of '08. And I was saying at the time, should the Fed be operating policy based on the 12-month lagging trend in the consumer price index, or should it be operating policy based on where they think it's going? And where was it going? Well, in the next 12 months, inflation was running at -2%. And if you made that call in the summer of '08, if I did that on the Merrill trading floor, I would have been carried out in a gurney. But that's what we're talking about. Everybody is just extrapolating what happened in the past year into next year. That's very dangerous. Everybody is living in the here and now and can't see past the tip of their nose. But you see, what I do is I do a lot of hardcore work on the pressures on inflation, the pressures. So that means focusing on aggregate supply, and it means focusing on aggregate demand. And what else do you want to ever hire an economist for? Because you could do this for anything. Now, we're just talking about the economy, but you could do this for commodities, you could do it for real estate, you could do it, for furniture and appliances, because every price is the intersection of supply and demand. And so it's a matter of when you're trying to determine the change in the price, which is inflation, how is the aggregate demand and aggregate supply curves moving in relation to each other? What do these curves look like? How are they moving? I know it sounds like I'm teaching an economics 101 course, but without that framework, you're lost. And all people talk about is the 12-month lagging trend in these price indicators. So I'm focusing not on that. I'm focusing on where my work is telling me inflation is going to be going in the next 12 to 24 months.
And where does it say it's going?
It says that in the US, we are going to be 2% or lower on headline and core inflation within the next 12 months. We will be at or below target, which is why I remain steadfastly bullish on rates and on treasuries. And the dips I'm buying are the price dips in the treasury market. Like we've seen, we'll get a hiccup because of supply. We'll get a hiccup because we get a couple of hawkish FOMC officials like Neil Kashkari. And there's nothing fundamental there. Yeah, I think that the big surprise, especially because, and this was a Bank of America, their monthly survey of institutional investors globally that just came out last week, showed that something like 56% of investors believe that the primary tail risk is going to be an inflation resurgence, and only something like 23% believe it's going to be a recession. And those numbers should probably be reversed. By definition, looking at how investors are positioned and just looking at the market narrative is going to be, as we saw in 2009, inflation is going to be surprising people to the low side. And as you said, all people were doing, I mean, remember all the oil bulls back in the spring and summer of 2008, the narrative was what? The commodity super cycle. The narrative was perpetual double-digit growth in China and global decoupling from the United States. Well, that worked out really well.
To be fair to them, I don't think they saw the financial collapse that rocked demand globally. But yes, I understand your point. That was not the best call. This broadly supports your thesis. This came in today. Walgreens cutting prices on 1,500 items. They've joined Amazon, Target, Walmart all last week, said that they would slash prices on Amazon up to 30% on their grocery items. So now Walgreens, for example, gummy vitamin jars now cost $11.99, down from $13.49. Now, is this What are they doing here? Is this a broader trend of deflation amongst the retailers, or are they just adjusting prices because they've raised prices too much post-pandemic?
Well, I mean, the answer is yes to both. But if you go when you start rolling back price increases as gargantuan as they were, that's still deflation. Deflation is a rate of change. Inflation is a rate of change. It doesn't matter what the level is. The level doesn't matter. And I tend to find that people conflate prices and inflation. Inflation is the rate of change. Paul Volcker is known as the greatest inflation dragon slayer of all time, but at his tenure as leading the Fed from 1979 to 1986, the greatest inflation dragon slayer of all time actually presided over a 40% increase in the consumer price index. Prices never came down under Volcker, and that was after going up significantly for a 12-year period from 1970, right through to 1982. And so what he's renowned for is taking the inflation rate, which is what matters for the markets, not the level, from 14% down to 4%. So the answer to the question is yes, that's what's happening. We are seeing a rollback. Prices aren't going back to where they were pre-pandemic. That's not going to happen. But you are seeing prices starting to adjust lower. I said before, the only reason why you're not seeing outright deflation in the CPI is because of the rents. You have other things in the CPI that just never deflate, okay, that have nothing to do with the economy. Do tuition rates ever go down? Education costs? No. Does healthcare ever deflate? No. There are just some things that are essentials, that are price demand inelastic, that just don't go down. Have nothing to do with the economy. They have nothing to do with Fed policy. But for example, we construct at Rosenberg Research a cyclical CPI. So we've taken all the goods and services and correlated them with the business cycle. Guess what? Guess what? For the past 2 months, the cyclical CPI is running negative. It's deflating. Just back to your point. Yes, and you're seeing that in real time, but you're also seeing that in the data. People say, well, you have all these companies in the retail sector that are rolling back their prices. It's not showing up in the CPI. Well, no, it is. It's just that, Walgreens isn't a landlord. It's not about rent. It's about things that are on the shelf. Those things are deflating. The Atlanta Fed does us all a huge favor. They produce a monthly statistic from the CPI that shows a sticky price index and a flexible price index. By definition, things that are sticky, and I hear this all the time, sticky, 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 sticky. Well, by definition, prices of sticky things don't tend to go down. And those things are, as we talked about, rents and education, healthcare. There are things that just never go down, even in a depression. But the core flexible CPI from the Atlanta Fed is outright deflation right now. Outright deflation. The stuff that is linked to the economic cycle is deflating, and that downward momentum is actually accelerating. Well, what more do we need to talk about? The beige book. The beige book is not a piece of data massaged by government statisticians. I'm not a conspiracy theorist, but so much of the service sector pricing in the numbers we get from the government are imputed. The beige book's just the beige book. It is what are business contacts telling the Fed? And the last 5 have just been this. The corporate sector writ large is losing pricing power. And that came through with the latest beige book that went through to the end of March with an exclamation mark. So yes, there is deflationary pressures that are intensifying in the economy that clearly aren't fully priced in by the Treasury market right now, because the Treasury market is being held a prisoner by this ongoing higher for longer Fed policy. But when we get the end of this higher for longer Fed policy and the inflation numbers come to fruition based on what our models are telling us, we're going to have a monumental rally in the Treasury market. It's gonna shock a lot of people.
The TLT is down something like 50% since its highs, right? That's a trade you'd be getting on.
Absolutely. I mean, I'd be saying if you want the biggest bang for the buck, you buy, long dated zero coupon bonds. If you want to hedge your bets, you could buy the 10-year. But I think like I mean, a lot of people think that the long bond can't go down because of a fiscal premium. No, the whole curve will come down. The longer duration you have, the greater the price appreciation. And when I talk to people about this, it's interesting, especially equity market people. It's funny. I've been in this business 40 years, and I always find that the bond market people understand equity math. The equity people don't understand bond math. And I get this all the time. Who would ever in the right mind lock in, 30 years at 4.7%? Well, A, nobody's locking in. Is anybody locking into the S&P 500 with a dividend yield of 1.2%? Nobody ever talks about that. You're not locking anything in. There's nothing more liquid than the Treasury market. You're buying it for the capital gain potential, not for the coupon. And if yields go down, even 100 basis points, you're going to make almost 30% in the long bond. That is the bond market math. It is the duration. It is the convexity. 90% of your return is going to come from the price. You're not buying it for the coupon. So the total return, I think that you'll find that the next year, with the recession call, and even if we don't get the recession, I'm starting to see a fundamental shift in terms of how is aggregate demand moving in relation to aggregate supply. And it is very disinflationary, or in some cases, in the cyclical sectors of the economy, outright deflationary. And I love identifying these anomalies because guess what? What I'm talking about is not priced into the market right now.
Okay, that's a key point. Now, the 10-year has been positively correlated with the S&P 500 the last couple weeks, couple months. I think if this correlation holds, we're assuming then the stock markets will correct downwards as well.
Well, I think that the stock market probably should correct down. Whether it will is another question altogether because the stock market has definitely surprised me for this year. But what I will say, it's like the title of one of my recent reports was No Market for Old Fundamentalists. And I continue to hear all the time about how this is an earnings-driven stock market. Really. So earnings are up 6% in the past year. And just before this latest correction, most recent correction started, the market was up almost 30%. Like the price action outpaced the earnings action by a factor of 5. And from the nearby lows in October in the S&P 500, the multiple's gone from 18 to 21. A 3-point multiple expansion in 7 months? Hello? That is a 2 standard deviation event. It's been a multiple-driven market. I think primarily there's so much confidence out there. Confidence that there's no recession. Confidence that the business cycle has been repealed. That we'll be in this elongated, quote, soft landing in the economy. But principally, it's the AI boom. It's the AI boom. This thought process, just like we saw with the advent and extension of the internet back in the mid to late 1990s. There's this view that this new inflection point in the innovation or technology curve is going to make us all rich. It's going to have a monumental impact on the economy and on earnings. And we got to get ahead of it now. Nobody even knows what the total available market is going to be for AI or for the chips. It reminds me of what investors were pricing in for fiber optics, and you had to load up on Nortel back in the late 1990s. I'm not going to say it's going to be a repeat, but what I am saying is that how does someone like me who is wed to fundamentals and wed to valuations tell people what to do with the stock market when it is so abundantly clear that this is a momentum, FOMO, speculative market? So if you're going to be long the market, I would say at least hedge your bets and sell some call options against your portfolio. Because We're talking about even when you adjust for the level of interest rates. I mean, it's one thing to have this multiple expansion or the multiple level. It's the top 10% most expensive stock market of all time. It's one thing to have this happen when interest rates are zero and your discount rate is so low that your future earnings stream, when you discount it back, looks like Jack and the Beanstalk. But when you normalize the multiple for uh, where interest rates are, where the risk-free rate is, uh, this market is well over 30% overvalued. And that's my conundrum is I'm just watching the clown of the circus continue to blow up the balloon. The balloon hasn't popped yet. You're waiting for that fateful day when it's going to happen, and it doesn't happen. But the bottom line is that that's my biggest concern, and everybody is just balls to the wall along the stock market. And it's a real collective groupthink in what I'm seeing as a speculative mania. So that's my big concern. We haven't had the storm, but the clouds are rolling in, and frankly, I'm rather concerned.
You have this chart here on one of your reports recently, 12-month expectations of higher stock prices. It just went up in a straight line in the last year. Yeah, this is an
Yeah.
interesting chart. I have two theories as to possibly why. Please, add your own or correct me if I'm wrong. Number one, so earnings scorecard for Q1 2024 of the companies that have reported, 78% of the S&P 500 have reported a positive EPS surprise, 61 positive revenue surprise. And now that's theory number one, that companies are indeed actually just performing well for whatever micro reason. And number two, perhaps the market agrees with you, David, in the sense that they see disinflationary pressures as well, possibly, thus lower rates, thus higher valuations because of lower rates.
Well, let's dig into that narrative. Firstly, um, companies, the plurality of companies always beat their estimates. And actually, the average is about 80%. And that's really games people play on Wall Street, where the estimates going into the quarter are lowballed, and then voila, companies are beating their estimates. Um, so that doesn't impress me so much. I said before, look, if the stock market was up 6% in the past year, and it was occurring because earnings were up 6% in the past year, which they are, then I'd say, okay, you know what? This is actually an earnings-driven market. Earnings are up 6%, market's up 6%. Okay, I can argue that makes arithmetic sense. But the market, well, right now is up more like 25, 26%. At one point, it was heading up more like 30%, but we're heading into what seems to be a correction mode. So you got the price momentum in the stock market outpacing the earnings momentum by a factor of five. So what I'm trying to say is that this has been a multiple expansion, a multiple driven market, not earnings, and it has nothing to do with the fact that you have companies beating their earnings estimates to the same degree and share that they've done in the past. Yes, indeed, inflation coming down, interest rates coming down, that will be helpful. However, what does inflation coming down mean? It means that companies, as I said before, and the Beige Book was replete with this, is the corporate sector is losing pricing power. Well, if I'm not mistaken, pricing power is the same as top line. So they're losing pricing power, they're losing top line. So the question is, how do you preserve your margins? Well, you got to cut costs. How are you going to cut costs? Well, at some point, you got to start cutting your most important cost, which is your labor, which hasn't happened yet. That hasn't happened yet. But to preserve the margins and to also underpin your productivity ratio, companies which have, by the way, been cutting the hours of their employees over the past year, they have yet to cut the bodies. And I'll tell you, the first time we see non-farm payrolls print with a minus sign in front of it, and remember that the companion household survey has had multiple negative readings in the past year on the headline, but that doesn't drive the market. It's non-farm payrolls. And like the CPI, non-farm payrolls is the holy grail for the Federal Reserve. Can you imagine what happens if we start to see negative payroll prints? But this is what happens when companies start to lose pricing power, and it's just pure logic that to underpin their margins, they got to cut costs. Now they've already tried doing that because they've cut the work week to the bone. Hours first. That's why the work week is one of the leading indicators in the Conference Board's LEI. Next comes the bodies. Next comes the rising unemployment rate. The excess slack in the labor market puts downward pressure on wages. And that's the scenario that brings interest rates down significantly over the course of the next, I think, 6, 12, 24 months. This will be prolonged.
Which comes first, disinflation or higher unemployment? We already got slightly higher
Mm.
unemployment, 3.9%. Is there one that leads the other usually?
They're both, well, it's funny, they're both lagging indicators.
Okay.
Uh, and I think historically you probably find that inflation peaks first and rolls over. And then as companies see the pricing power being diminished, they start to realize this is not a one-off, it's a trend. That's when they start to respond to their loss of pricing momentum by rationalizing or downsizing their workforce. That's normally how the cycle plays out. So you'll see inflation first, unemployment, and you're quite right. Look at what's happened in the past year. Inflation has still come down a lot. I mean, it's had this bump in the opening months of this year for the reasons I cited before. It's not, to me, that's not real inflation. Insurance premiums, what are you going to do? Stop driving your car? You got to pay those. But the unemployment rate only recently, I mean, inflation's been coming down. I mean, it peaked in the summer of 2022. It came down significantly last year. The unemployment rate only recently started to tick higher. So inflation first, unemployment next.
So you are expecting higher number of layoffs across all sectors?
Well, I don't know across all sectors. Is the healthcare sector going to lay off people? It's not really cyclical. Is the education sector?
Cyclical sectors, yeah.
There's some areas that just they have nothing to do with the economy. They're just basically things that you need, and they will continue to grow. So, but the more economic sensitive, manufacturing, construction, retail, uh, home building, they will come under the knife.
I think some people are wondering also what will happen to their wages. Now, the Atlanta Fed wage tracker has been steadily declining. It was at 6.7% in 2022. Now it's at 4.7%. It's a 3-month moving average of median wage growth. Uh, People want to know if their wage growth will still beat inflation. What's your take?
Most likely, yes. I think that we will find that the inflation and the prices will be less sticky than the wage growth. So I do think that we will see a flip. You could argue, will that ultimately help out the consumer? And at some point, and maybe towards later next year, yes, that's going to be the case, that will help out real incomes. But you see, when the unemployment rate is going up and when you see, your friends or your family or whoever, you start seeing people losing their jobs, you tend to have your confidence level come down. You tend to save more money and spend less. So
Even if
because
prices drop, David, even if prices drop at
even if
Walgreens and
prices
Amazon,
drop, yeah, you see, the thing is that the question becomes, yes, are we going to get real income growth based on this projection? Yes, but income doesn't go into GDP. It goes into GDI, but not GDP. GDP is aggregate demand. It's all about spending. The question then becomes, how much of your income are you going to spend? And when there's economic uncertainty that is rising and elevated, then what happens is that even with inflation falling faster than wage growth is falling, and that gives you a nice recovery in real incomes, the next question in your forecast is, well, what is the behavioral pattern going to be in terms of the saving spending trade-off in that income flow? And so as that period is coming, unemployment rates going up and people losing their jobs, and of course, alongside that, you're going to have a bear market in equities. I hate to say it, but that's just part of Mother Nature and it's the cycle. The savings rate's going to go up. And that's something else, right? Is that where's the savings rate right now? Where's the US savings rate? It's barely above 3%. American consumers are saving the grand total of 3 pennies out of every after-tax dollar they earn. They're saving 3 cents, spending 97 cents. It's almost unheard of. But of course, when you're looking at your 401ks and you say, look at the stock market, why do I have to save any money? My 401k, my pension is going to look after. Look at the stock market. A very dangerous game to play, but we've seen it played before. Usually, right at the end of the cycle, the savings rate gets depleted because people are just too confident. Before COVID, the normalized savings rate was about 8%. It's now 3%. And you have to start thinking that even if we get a situation where real incomes start to go up and you start building these scenarios, the next question is going to be, what does a mean reversion of the savings rate? And of course, I talk about the savings rate to non-economists and people's eyes, they glaze over and you sound like an economics professor, but I would actually say that the personal savings rate is arguably the most important behavioral component of the national accounts. So I think that we're going to go from what has been a prolonged period of dis-savings towards higher savings. That's not the end of the world, but it's going to come out of consumer spending growth, which I think will be in the penalty box for the next couple of years. So that's the other element we have to talk about. People will think, well, oh, Rosenberg is talking about the fact prices will decelerate faster than wages, higher real income growth. That's great news. Well, standalone is great news, but you can't look at the economy this way in a vacuum. It's much more complex. I think the overriding theme is going to be a prolonged period of consumer frugality after the wild spending spree with all the stimulus checks over the past 3 years, the YOLO spending, you only live once, anger spending, revenge spending. That's in the rearview mirror. So the key is going to be, even with better real income growth, where's the savings rate going? And it has nowhere to go but up from where we are right now. It's just too depleted. And that's once again what people are factoring in because the consumer is 70% of GDP. And we're talking about a period where we're going into a saving cycle, which I think longer term is necessary, but it's going to have a dramatic impact on what I talked about earlier, which is that aggregate demand curve and how that demand curve is moving in relation to supply comes back to square one, which is disinflation. Which I'm going to tell you something, people refuse to believe this story. I have the numbers, we have the models, and I have the experience and intuition. I could tell you that that is a high conviction call. The disinflation call is a high conviction call. We have a starting point right now of a 3% savings rate and a 4% unemployment rate. That's our starting point right now. They're not getting any lower. The fact that they got as low as they did was part and parcel of the inflation that we had in our hands. That is in the rearview mirror. So we have to model the US economy in the next 12, 24 months that the savings rate and the unemployment rate are going to undergo a classic mean reversion trade, which is going to be, again, intensely disinflationary, if not outright deflationary.
Recent study by Fitch Ratings found that subprime borrowers were 60 days or more behind on their car payments. On average, vehicle repossessions are up by 20%, the most in a number of years. Now, David, at what point is this going to roll over to the housing market? At what point are we going to start seeing repossessions on homes?
Well, I don't think that's really going to happen because, I mean, not on a grand scale, because um, homeowners in the U.S. have built up so much equity, and it remains to be seen just how tight the backdrop's going to be. This is again, it's one of the peculiarities coming out of COVID and these low rates. Everybody locked in their mortgage. There's no supply, and even though demand has been weak, I mean, demand has been weak. Demand has been very weak in the housing sector. I'm talking about the resale market, which is 85% of the market. This has been great news for new home sales and up until recently the builders, because that's been the only safety valve, but there's no inventory. So even if you have weak demand bumping against weaker supply will generate real estate inflation. You have real estate prices up 7% in the United States over the past year to record high. So you see, you're only really going to hand your keys back to the lender or have your unit repossessed if you fall into a negative net equity position on your home. And frankly, as obviously as cautious as I am, I'm not focused on the housing market as a source of delinquencies, defaults. That was the last cycle. Lightning doesn't strike twice, and the mortgage default rate, although it's up off the lows, is not anywhere close to problematic levels. But the things that you talked about, auto loan delinquencies, big problem. Credit cards, that's a $1.3 trillion market. It's as big as subprime was. No, you're not going to repossess, you don't live in your credit card, and most people don't live in their car, but I think probably some people do. However, it just speaks to uh, a, a credit contraction, not necessarily in the housing market, but in very important segments of the consumer loan market. We are seeing a credit contraction take place. And at the margin, that's going to have an impact on consumer spending. But I want to make the point that this is not about the mortgage market this time. It's not about housing. That's not where the bubble is. It's in really in other parts of the market, and subprime and auto loans are big enough. We even talked about in the business sector, corporate loans and commercial real estate. People don't think there's a bubble. Yeah, there's a big debt bubble. It's just this time it's not in residential mortgages.
Ultimately, then, what are you recommending for asset allocation? We already talked about bonds
Mm.
and treasuries. What else?
Yeah, like Treasuries. I think that once the Fed starts to play ball, the U.S. dollar, which is overvalued on almost every metric, is going to come down. And the yen is got to be like a coiled spring when you think about it. I've been saying that for a while. Only now is it coming to fruition. But I think that I am bearish on the U.S. dollar. Ergo, I'm bullish on gold. And in fact, I would say that commodities, which are priced in US dollars, will be a good place to be in your asset mix. I'm not going to get into individual commodities, but you can think of base metals and oil, precious metals. But commodities will be, notwithstanding the fact that the economy will be weak and you're going to have very weak demand for basic materials. And China's in the penalty box economically now for a prolonged period of time. That's not going to end. However, the supply curve for the commodity sector, the supply curve, you can't forecast prices just based on demand. The supply curve is very inelastic. It's an area that has been underinvested for many, many years. So commodities are actually scoring quite well in our Strategizer publication. If you're going to be invested in equities, I think you have to be very thematic. And I think that means you want to be in the more defensive, non-cyclical sectors. Could talk about consumer staples. Utilities seem to have the best of both possible world because they're benefiting from the energy needs needed for these data centers related to AI, but also utilities are interest sensitive. They typically do much better when interest rates are coming down. So you got utilities, you've got staples. Selected REITs will do better in a down cycle interest rate. So I would not be buying, the index, but there are specific sectors that will do well in a lower rate environment. At some point, if the Fed cuts rates and the yield curve pivots to a positive slope, I'll be talking more positively, and this is probably more in next year towards the banks and the financials. Outside of that, you've got to think, as I said, where the secular tailwinds. And although we can talk about U.S. technology, I mean it's so overpriced. I mean I'm looking at the PEG ratios for tech. They're 50% higher than they've been in the past. And I guess you could say, well, the tech sector is being re-rated for AI, but to me, right now, it's early stages. The internet was real back in the mid late 90s. Internet was real, and it was profound in terms of the impact it had on productivity and the economy and how we live, both commercially and personally. What was bigger than the internet? But yet, from 2000 2002, the S&P 500 tech sector went down 82%, 82. And so, that's the problem when you have a price bubble, even if the AI thing is real, which I think it is. It's just that so much anticipation and assumptions are being put behind what the price action has been. But I like Japan. Tell you the truth, there's secular tailwinds there because they're being re-rated for all the structural reforms taking place to boost shareholder returns. India has got just a long list of positive secular tailwinds. We could debate about Modi being a divisive national leader. However, he's almost been like a Ronald Reagan, Raul Moroni, Margaret Thatcher type when it's come to the economy. And when it's come to, I mean, they have 9% growth and it's almost all productivity. They have a young, vibrant, huge population that are well educated and speak English. So I'm trying to tell people, there's the US market, but there's another 70% out there called non-US. And it's not hard to invest globally these days. So I would say that we have liked Japan, India, Brazil, Mexico. Um, we're starting to warm up to some of the emerging markets. The famous line is emerging markets are markets that you can't emerge from in an emergency. But when I'm like taking a look at the Hang Seng trading at an 8 multiple, and they're thinking at an 8 multiple. 8 multiple is where the S&P 500 was trading back in the summer of 1982, when nobody wanted to touch the stock market. Nobody wants to touch emerging Asia, but the valuations are looking very compelling. So I am not telling anybody, hey, I'm so downright bearish. You got to buy barbed wire and canned tuna, and baked beans. There are areas to put money to work, but I would say the prime focus should be on capital preservation, uh, non-cyclical parts of the equity market, focus on capital preservation, diversification, the preservation of cash flows, and to focus on valuations. There are parts of the global stock market that are trading at compelling valuations. They are not in the United States, but we'll return to that at some point. My biggest conviction call is disinflation, uh, and that all roads lead to lower interest rates, and the biggest potential return across all asset classes, I think, will be in either 10-year or 30-year Treasury bonds.
Final question, I'll let you go, David. If you're looking for high income or yield, where do you go in a falling rate environment?
Well, look, there's some parts of the stock market that will give you yield, right? I mean, you could focus on, I said, utilities. You can they will give you, I mean, I always call the utilities bonds and drag, but now they're being re-rated for more defensive growth characteristics. That looks very interesting. Telecom is looking very interesting. So again, that is yield sensitive. I want to buy in the stock market what I call bonds and drag, and those are like the high dividend yield, high payout ratio parts of the stock market. Um, Outside of that, I would have to say that uh, treasuries, I said before, well, treasuries will give you the income stream. It's not a whole heck of a lot. But look, even if you're focusing on treasuries at a 4.5% yield, if inflation goes down to 2% or lower, that's a 2.5% real yield. I think that irrespective of what the capital gain does on the price appreciation, if yields come down, I think that's a pretty good deal. It doesn't sound like a great deal when you're in the midst of a huge equity bubble, but people will look at it in a relative way as being very attractive. Outside of that, look, the Fed is going to be dragging its heels. They are relentlessly focused on lagging indicators, and it's going to take a while for these lagging indicators like inflation to get to where they want it to be. And the election is going to get in the way of the timing. So look, you're getting paid. You get a 5.5% in money market or treasury bills. So I would say to have a stash of cash on hand, and you're getting paid for it. You're getting paid for it more now than any other time since the mid 2000s. So I'd say that have a stash of cash. You're getting paid, and it's going to provide dry power to buy other assets that are going to cheapen up over the course of the next year.
Where can we follow your work, David? This has been a great talk. I'm sure the audience has learned a lot, but if we want to learn more, where do we go?
Well, you can just Google Rosenberg Research. It'll take you right to the website. Or you can just come straight to us, information at rosenbergresearch.com. And I have a client service team, and everybody on this webcast, I will be happy to give them a 1 month free trial of of all my products and services, so you can kick the tires and see what you might like. But information at rosenbergresearch.com is where you'll come directly, and one of my client service team will help you out.
Okay. Well, we'll speak to you soon. Hopefully not too long from now. So thank you very much for your time today, David. I appreciate it. And everybody, make sure to follow David in the links down below, Rosenberg Research. And we'll see you again next time. Thank you.
Take care.
And thank you for watching. Don't forget to like and subscribe.